Guys. I've never spoken on the space before, but I thought I'd qualify myself real quick. So I wanted to give some perspective to the crew. Just cut me off if you lose me. I'm a portfolio manager up in Montreal, one of the largest in Canada. Owned Tesla stock for clients since 2016, in and out. Personally, I've owned it, never sold. So I appreciate all the work you guys do. What I wanted to do was share some perspective, because I know you talk about the business in itself, the importance of it, and what they're doing, but also from a stock perspective, I think I have a pretty good understanding of the market dynamics, and I can tell you what my opinion is of what's driving the stock currently and what could drive it higher. First of all, if we just look at the NVIDIA, okay, we've owned NVIDIA for many years as well. Currently, it's our largest holding. Tesla has been for a long time, but because of the sell-off, it is no longer. But that will change. Our belief is that Tesla will probably be the most significant value to our funds or pools over the next 10, 20 years. So what we saw with NVIDIA, and to give perspective to people at how the market works, it's just a mechanism of buying and selling. When you have more buyers in a day, more sellers, we look at the volume. And when we look at NVIDIA, would be an excellent case. 2 years ago, we had calls from clients complaining they didn't want to own the company. The stock went down to, probably close to $100, $150 in 2022. And the reason it did was just and even personally, I was concerned about the company because their technology is far greater and above than what I can actually comprehend and understand. We just knew that they were a leader in chips, and we knew that there was a chip war going on. And so we continue to own it despite the fact that we had a lot of client complaints. And since then, everyone knows what's happened with NVIDIA. But the only time NVIDIA started to turn is when there was rumors, or when Wall Street could actually get an understanding of what their earnings are. So the stock moved not because of the potential. And the reason I think this is important is because as a Tesla investor, we're all watching the capabilities. I've had FSD for a number of years. I'm testing it. It is friggin' awesome. I know that this thing is next level. I have no doubt. But until Wall Street and analysts can put this into their numbers, I don't believe that we'll get a significant move to new all-time highs. Sure, 200, 250, maybe it'll trade back to, but you need to start putting in the numbers. And if you look at any stock that is significantly run, that's not a meme stock, you're going to see that people start understanding the numbers. Even NVIDIA today, you look at it, forward PE multiples, everybody's trying to make sense of it. It has not gone up in terms of valuation, but there's earnings behind it. Maybe the stock can run a little bit sooner, but in terms of Tesla running because they're doing awesome things with AI, we have to start. So I'm just putting it out there. Where are we going to see Tesla start delivering it in terms of numbers? That's it for me.
Yeah, that's fantastic. Can I ask you then, like you said, significant numbers, right? So does it have to be, significant, like as in 10% of the current revenue and the current margins that Tesla's doing today? Or let's say they start selling the bot next year, and then 2 years later, they sell 10,000 bots, and they can show margins that are through the roof, and then you can calculate there. Is that enough, or do you need to actually just simply, here's the margins, let's do a 5-year, cash flow backwards, and then try to calculate from there?
No, it's a good question, Herbert. So if you go back to when Tesla started with their 30% gross automotive margins, and this was back towards the end of the financial crisis, even us, we were running multiples and going, okay, they have 30% gross margins. What's this company worth? And they're going to grow at, they say 50. We put conservative numbers in, and we said, look, okay, maybe they can grow at 30%. Let's be conservative, 25, 30%. That if they can do that with those margins, we're going to put a 60 times earnings on the company. We'll use EBITDA, but we're looking at going, okay, it's still cheap. So we got out of the company, but we started getting back into the stock when the stock was like in the 300s back in 2022. And we kept for clients and we kept buying it on the way down. And I kept believing this is probably one of the greatest opportunities we've seen in a long time. And we were buyers of Apple back in 2009, 2010, as everybody said, these iPhones are too expensive. And I see this as a repeat of, the market not fully understanding this. And we do see, I talked to my partners about this, we see the vehicles at the delivery mechanism, very similar to an iPhone being a delivery mechanism to the software that's supported by it and the App Store. And so we see that happening. In terms of when do bought, I think you just have to start running the numbers. Once they actually start selling some bots, first they'll sell that to themselves, and once they can prove that they can ramp up, so they get to 10,000 bots, 15,000, 100,000, and they show margins on these, that's when the street will wake up. But I think what the street has to start understanding is, what do we give a multiple for this projected growth rate and into infinity, not 1 year, not 2 years. So why does Microsoft get a 30 times multiple for a company that grows at maybe 10 times, 10% earnings per share, maybe 15? Same thing with Visa. Okay, because we see it almost in perpetuity. We can't see the end of that slowdown. Yet why does NVIDIA, who's growing at 60, 100% per year right now, get the same multiple? Because we can't understand, or we can't quite grasp how much growth is beyond 2-3 years out. And I think if Tesla can start proving that there's consistent 40, 50% growth, if they can prove that, they'll get a 40, 50%, 50 times multiple on their actual earnings. Right now, the stock is actually expensive, but I think the market's going, hey, wait a minute, there's some stuff here. There's some built up earnings potential because as an automotive stock, it's way too expensive. So it's not completely discounted.
Okay. And then what about Robotaxi? Like, isn't it, you don't see that as, like it's either on or off. So the very first time they actually have a city or two cities or a country that is able to charge Robotaxi services, they're actually showing the business model. That's not enough. You still need to see, I don't know, 10 cities and significant revenue before fund managers like you would do something about it.
I think, in the U.S., my view is it's going to be very similar to Whammo and Cruise, that it's like a token thing in a few cities. But I think once you get an automaker, I think it's going to happen in China first, and I think it's going to happen really fast. Once you have one company, it may even be BYD that signs on. And when the market starts seeing that this licensing is recurring revenue, I think that's where you'll see this stock start to take off. And I think it's an easy run from $200 to $400. What I'm talking about is, how does the market wake up to $400, $2,000? You got to start proving that. Before we have the NVIDIA moment, we need to have proof of actual earnings. And the speculation of what are these earnings going to be, or when we prove Robotaxi starting to work, that'll put the stock to $200, $300, possibly $400 if you get a meme rally. But I still think you have to be patient and wait for those earnings to come. And then so let's go back to 2000 to 2020, right? If you're invested in the stock, you're watching this thing go up, and the only time when it
Oh, we lost you again.
started running,
Yeah, you're back.
when it finally started running, it actually had to do with earnings, and everybody just looked at what are their gross margins, what's their net revenue, and all of a sudden they said, wait a minute, this stock it did the same thing that NVIDIA is doing today. It all of a sudden was trading at 30, 40 times earnings based on their actual earnings, because it had operating leverage. And so this company does have operating leverage, but we need to start seeing it. And it could be just 1 quarter, 2 quarters, that they just all of a sudden nail it, sign a couple agreements, and people start putting it into their models.
And then what's your perspective if there's a licensing agreement announced with BYD, like you said?
that would be that would be interesting. I think if we saw that, we could see stock rise 10-15% just on that news, similar to the supercharging network. But again, until we to see the company double 3x, 4x, 10x, I still think we actually have to see the numbers, because it's such a large. This is a $500 billion company. To move the stock, it takes a lot of weight. This thing's not going to move like a GameStop or a video place, the other place that was running.
Appreciate that. Okay, Sat.
Yeah, I think there's another aspect to it is that Wall Street always is going to be a lagger. So people who have been in Tesla will notice it beforehand. But by the time earnings come, it's already been rising, or you missed the boat because you can't buy it when everyone already bought. So that's part of the reason why, like, you're going to have the valleys. This is a period of the valley. Um, and I think it's more like something that's coming from left field that's going to really move the ticker in terms of Tesla. Typically, it's been something completely like trivial compared to what we're looking at analyzing the business operations. Like part of that rise that you're talking about in 2020 was the 100,000 vehicles ordered by Hertz. But if you calculate the numbers, it's in the billions, but it's not enough for it to be 1 trillion. So it's always going to be something to the left field, and I think it's going to take a while for at least the market to acknowledge it. But I think if there's news of potential like 8.8, maybe they're going to talk about a platform. They're talking about a rideshare app, so it's creating a completely new ecosystem. If they provide some kind of information that can be tangible enough to calculate, then even the retail investors are going to be willing to go into it more. I think the retail base is much bigger, and Tesla is a much bigger focus for everyone. And I don't think you're going to have to run up of that kind of 10x because it was the first time, obviously, it was entered into the SP 500, which enabled Wall Street portfolio managers to actually invest in it. They're barred to do so because of the rating. So a lot of them could not include it in their mutual funds and other funds. So there's technical aspects, logistical parts, but in terms of the business stuff, it's always going to be something left field that it wasn't expected. That's going to move it, and then you have the market and Wall Street come after when earnings is unexpectedly double or 50% more than what they calculated. Like in Nvidia's case, the earnings came out way over what their estimates were, and I think that's when it starts moving. So I think there's two different aspects of the wave.
Simon, I was going to ask you, what do you think about the vote? As a portfolio manager, do you make that decision on your own, or are you hearing from your clients? And what are you hearing from your clients regarding this upcoming vote?
Can you hear me?
Yes.
So we actually placed our vote for clients. We've got 300, almost 400,000 shares for clients, and we placed the vote in favor.
No, that's great. So are you deciding that on your own, or what are you hearing from the clients themselves? Is there backlash going, well, we don't want you to vote this way, or nothing?
And that's actually a really good question. So first, we haven't had backlash, but we have had some clients sending us messages asking, how do we go against this vote? Because there's a misconception among retail clients about what's actually happening because of the fake news. So an email I received from a significant client recently believed that this would affect Tesla's cash flow by $45 billion. And they want to make sure that they could vote against electing to give Elon his shares. And this was coming actually from somebody who was an accountant. And we actually had to speak to them and say, listen, it's actually not, it's already been given out. It's the shares. This is not cash flow from the company. And this is actually a good thing. But the media portrays it wrongly. And it's surprisingly that we have some pretty intelligent clients who actually don't understand that the terms of this, when it was put out, 8 years ago, And I looked at it, at the time when it was first proposed, and I said, "This is brilliant. I wish we could pay all of our CEOs this kind of comp. You 10x my money, you 10x my cash flow per share, you 10x production. You give me a 10 bagger on every stock, and if you don't deliver, we pay you nothing." And as a PM, I would take that any day. And he delivered, and we're saying, okay, we're up in Canada, but despite that, we're saying this is ridiculous. This is not right. He earned every single dollar, and we want him at the helm to deliver the next 10x. So I think we should give him his comp that we promised him, and we should put another one in place to 10x the shares again, because only Elon could do that.
Exactly. So Xander, did you want to jump in?
Yeah, I was just going to ask, and maybe Simon can share his thoughts first. What would it take for the media to stop spinning everything in the negative for Tesla?
I think there's two issues. One is Tesla's the story that just keeps on giving, and it grabs clicks, so it's clickbait. And the second is, I'm not a conspiracy theorist, but you look at which companies, which businesses, which organizations or government don't want Tesla to succeed because it would disrupt their business, whether it be unions, whether it be legacy auto, whether it be big oil, whether it be energy companies. There's so many entities that do not want Tesla to succeed. So I'm not sure what that would take. My take recently, as I started thinking about this, and I'm in Canada, but there's a couple states in the U.S. that really have a belief of you gotta be free. There's one state, I think it's New Hampshire, that had a license plate that says "Live free or die." And I think Americans are all about America and big trucks and make it here and be free and free speech. And that's really the foundation of what America is, without trying to sound like a redneck. But and so I'm thinking, shouldn't like Americans who really believe in America only buy Tesla because it is the most American company and because it represents freedom, free speech, non-unions, non-corruption, no governments that are interfering with with policies. It's probably the most American thing and company that I can think of in a long time, right?
Oh man, Simon, that's crazy talk. What happened to you, man?
Absolutely, you would think that it being the most American company, but
Okay, Lord Perduflaco, welcome back up.
Hey, how's it going?
GameStop, baby.
That was a fun day.
Did you have your hand up?
Yeah. I actually wanted to take the other side of some of I think it was Simon's points regarding Wall Street, regarding how they model, how they might interpret the outlooks and stuff like that. I mean, one anecdote is that there's a woman named Frida who is a principal analyst at Altimeter. You guys might have heard of Brad Gerstner's fund called Altimeter. And she puts out quite a bit of work that kind of gives a little bit of a glimpse into the sophistication behind hedge funds. When we talk about Wall Street, I think people get this idea that they love this narrative that oh, Wall Street just can't really figure it out, or Wall Street needs more evidence or proof or whatever. The reality of the situation is these are very sophisticated market participants who have teams that they cross-reference and work within to develop thesis, develop comprehensive models, and calculating intrinsic value. The biggest thing, in my opinion, with some of these key lines of businesses, so like Optimus and the Robotaxi business, is really the discount rate being applied to it. I don't believe that they have a hard time understanding the opportunity. I think everyone understands the opportunity. And, I took like maybe 3 or 4 days. I already built an end-to-end model. And I'm already developing the entire thesis behind robotaxis. And I haven't worked in Wall Street in like 10 years. This is not really difficult stuff. So I don't think that it's the case that like necessarily like, you know, Wall Street, you know, has a hard time figuring out, or that they want to see results first. That's absolutely not the case. The stock will get priced in ahead of time, as stocks do. It's just a matter of what are going to be the triggers that are going to enable investors to incorporate these new lines of businesses into their DCFs with more accuracy and less discount rates being applied. For example, Robotaxi business is probably has something to the tune of like 90-95% discount being applied, because we have no idea how the rollout's going to look, whether autonomy will be solved in the first place, how jurisdictions and regulations are going to work, you know, how are customers going to adopt it, how is Uber going to react, et cetera, et cetera. So, you know, it's almost like, you know, given kind of like a 5 or 10%, you know, chance of success as of now. But that changes dramatically the day the fleet awakens, to use Elon's term, right? In the sense that as soon as there's confidence around concrete sort of shift in the reality of the business, with a key milestone such as, you know, level 4 being achieved officially, or the first pilot program being rolled out in a certain, you know, city in California or Florida or Texas, with more and more sort of like growing adoption within the United States, within Europe, within China, all of these will start to become factored into the stock price, and it will be dramatic. This isn't something that, you know, like, you know, when you think of investors, value investors are never going to get it. They're not our target audience. What you're really looking for are the tech investors, and they completely understand the opportunity at hand. It's just a matter of, can we get the right catalysts to trigger the moment that proves that, hey, this is not a business that we should be discounting by 90-95%. Maybe it's 80%, maybe it's 75%, and you start to scale that down.
I think it's a good point, and I agree with you, and I hope that's the case. Where I see a little, I wouldn't say differently, but I think the two smartest tech analysts on the street that are following Tesla and Ottawa analysts is RBC and JP Morgan, and I've gone through their reports pretty extensively, and they've modeled out, and the probabilities they've given very, very small probabilities of success, but even they come up with price targets of, call it 300, which is almost double where the stock is today. And these are very well reputable analysts or companies publishing this, and yet the market just doesn't want to recognize it. That's one of my issue. And they don't put anything on. I look at their valuation, and they're so conservative. Like, they put nothing on the car value sales. They put it's actually ridiculous how conservative they are. And I think the reason why they're so conservative is they don't want to get laughed out of their job. These are really smart guys, way smarter than I am, and I look at the work that they did on it, and I'm like, oh, they're really conservative. So I think these analysts will adjust their projections as it starts to unfold, and then it just comes down to operating margins. But that's the thing, is that it doesn't just have to be proven. I'm just astounded at how well FSD is evolving. It's staggering, and people don't know it. You're driving this, you're watching it evolve, and you cannot believe, you're thinking, oh my gosh, like, how does the world not know what this is? Nobody does. They don't. V12 was downloaded. I drove to my office, picked up as many employees as I could, and took them through Old Montreal and said, you guys got to see this. This is mind-blowing. And I don't think that most analysts fully understand it, even when they start to, like we're starting to see with JP Morgan and Royal. It just doesn't seem to move the stock until we can actually put some numbers into it. That's my, I hope you're right.
Yeah, I agree with you. I think that, you know, and you're probably referring to Morgan Stanley, not JP, but you know, historically, Tesla has always had kind of this bifurcation of analysts, right? With you have like on one end of the spectrum, you have people like JP Morgan that have like a $30 price target. On the other hand, you have folks like Morgan or now RBC, Dan Ives at Wedbush, et cetera, who have closer to $300 price targets. I think one thing to keep in mind, or that everyone should keep in mind, is where the yields are trading right now. The 10-year Treasury, for example, back in July, August timeframe, when Tesla hit $300, where was the 10-year? The 10-year was at like 3.5, a little bit over 3.5. Now it's at almost 4.5. So it's up almost 30% since, and we're down still 30, 40% since, right? So, I mean, to get back to 300 is kind of trivial. I don't really view that as like the bigger obstacle. So I don't know. I do disagree that I don't think that Wall Street, or I should say, just broadly speaking, the market is going to wait for quote unquote results to show up on the financial statements. I don't think that that's going to be the case. I think that the thing that's more correlated is what's the Fed doing and what are yields doing, and then more importantly, where are the breakthroughs, the concrete breakthroughs? Because Elon right now is the boy who cried FSD, right? So he's given very little credit. And of course, if you have not sat in version 12, you can't really understand the big difference that has just happened in the last couple months. But I think Elon has given enough signals. I think that analysts have always had a bifurcated view of Tesla. Even Morgan Stanley back in 2019, you probably remember, had that famous bear case and bull case scenario, right? The bear case is like $10, bull case is $400. And everyone was like, get the fuck out of here, man. Like, what are you talking about? And that was the 2019 bottom when they were talking about bankruptcy. So I think it's always been hotly debated. There's always been kind of price targets on both ends of the spectrum. But I don't know if that's the biggest correlation, So something for food for thought for everyone.
Do you think the 10-year is actually going, and this is where my question is we follow the yield curve quite closely. It was interesting in 2022 how raising interest rates brought down all of our tech stocks, but at the beginning of it, Tesla wasn't correlated, and that I thought a bit odd. We even talked about it with clients, and we said, listen, Tesla's in a class of its own. The market's going down, growth stocks are going down because interest rates are going up, and Tesla actually continued to go higher. And that's when I started to, I guess, question whether or not the interest rates are affecting Tesla. And that we all can agree that interest rates are affecting purchase of new cars.
Yeah.
But you understand what I mean. The market dynamics. Do you think that it's driving the market dynamics of Tesla stock, the 10-year?
Well, I think one thing to keep in mind, maybe someone can fact check me on this one because my memory is a little hazy, but I believe you're referring to the rally towards the end of 2021 that pushed us over $400.
Yeah.
Maybe someone can confirm, but I think that was around the time when the S&P announcement was made, or the addition to S&P.
It was that happened before. No, it happened before.
That happened before, huh? That was end of 2020.
Yeah.
Okay, yeah, it was one of those. Yeah, I don't know. I do remember that Powell had signaled towards the end of 2021 that they were going to start raising rates, and I think that was the beginning of the bear market. Tesla fought for a bit. I mean, it was a hot stock. You have to remember, like leading up to that, for the 4 years prior, it's the hottest stock in the market. So I mean, it was pushing up and trying to get out, but I mean, you can just look at the charts, like how it was trading. It was violent to the upside and the downside before eventually giving way. So I don't know. I certainly think that there's a correlation between, TLT, if you look at the charts, how it performed year to date, for example, versus Tesla. I mean, they're almost identical. So, we'll see. And TLT, FYI, is just on the verge of breaking out, which would essentially imply lower yields, right? And that coincides with where we are in the rate cut, the rate cycle. We're most likely going to start cutting in Q3 or Q4. And the outlook is going to be very bright for Teslas. That's why I actually think 300 by the end of the year is almost likely, in my opinion.
Oh, I actually believe you there. I'm just thinking the $500-600. Herbert, I wanted to comment on one other thing for all of your guests is regarding as I want to talk from PM standpoint in terms of people give Gary Black a real hard time, and recently Ross Gerber, and and I understand why, and it really bothers me that these guys are still talking about Tesla, but they own nothing in their funds. But that's what they do to get publicity. But the point being is that owning Tesla stock in your portfolio. So back 2019, we owned a 2% weighting in our portfolios. And when you're trying to run a business and you're trying to invest clients' money, it took up the majority of our time. So we owned 30, 35 companies in the portfolio. And every time we did a client review, every time we did a financial plan or tax review, Tesla would come up, and we would get bombarded with clients sending us emails about a negative story that they read in Tesla. And so when the 420 tweet happened, we have a policy whenever a company is going to be taken out or a rumor of taking out, or any kind of corporate action, that we no longer have visibility on the movement of the stock we sell. And the reason for that is a lot of deals fall apart and we just can't add any value. We're not a hedge fund. We don't have that much inside information. So we did end up selling. And then when the stock collapsed afterwards, a year or two later, we actually did not buy back, though I did personally. And the reason for that is, as a portfolio manager, you're running a business and you have to instill confidence amongst clients. And sometimes you just got to do what's boring and safe so that clients can, sleep at night. And so we made the decision at the time that Tesla was just too unmainstream, too volatile, too risky. But once they proved that they could achieve profitability and there was no chance in my mind of a bankruptcy, we thought that clients in the mainstream would be ready. We said, you know what? We own all conservative companies, and now this fits. We can own this for our clients, and I don't think we'll get a lot of pushback because now it's a $100+ billion company. They're cash flow positive. They have zero debt. And to be honest, we were wrong. It was probably the most difficult position to own and to add to over the last 2 years. And even today, our clients, and we've had to educate them. We've spent hours, we've done presentations. It's one company in the portfolio. And because I believe in the cause, because I believe it's worthwhile teaching people, and I have enough money personally that I say, you know what, and we're gonna be right on this. And clients will. We could afford to take that risk, but we've lost clients over it, just to put it in perspective. So like Ross Gerber, Gary, Gary Black, I know they're getting a lot of pushback from clients, and it's really difficult managing other people's money when the majority of the average investor who trusts you to manage that money don't believe in the story.
Wow, that
If
is
I could respond.
powerful. I'm still absorbing that, Simon. Thank you very much for sharing this from your perspective. Like you were saying, clearly you get pushback. You're talking to the clients all the time, and so this is why it matters, right? How Tesla's perceived out there, what kind of disinformation, misinformation, just crap that people are saying, because that's your clients. The clients just listen to that, they hear that, and then they call you going, "Why the hell are I investing in this company? Did you hear?" That's crazy that you have to deal with that. Go ahead, Sat.
Yeah, I generally disagree with what Lord Pretty was saying about the analysts. I don't think they understand a single thing about Tesla because it has to be in a financial model. If you can't model it, they can't understand it. So for companies like Costco or Home Depot, they're perfect. I'll take their lead any day. I'll read the reports because it's the same subscription, same amount of stuff, cyclical season thing. They understand that business, it doesn't change. For companies like Tesla, they've always missed it. To Netflix, they missed it. The 2009 to 2019 10-year run, they had 10,000% return. I had like 4,000 to 5,000% return on my Netflix, and I entered exactly the time what Elon commented on, when they did a quick stir and they're gonna basically switch off their main core business of the DVD rental, offshoot it, and everyone went into panic, and that's when I went in because I understand that they're streaming. right? You understand, if you understand the technology, then you know where it's going to go. It's just the CEO moved way too fast for the market and other people to understand. And they don't understand technology. So they understand financial modeling. So if it's not if possible to model, it won't happen. So until they do, they'll be negative about it, and they have a narrative, and they find the numbers to fit the narrative, not the other way around. They don't look at the
Not true.
technology business and then figure out the modeling. I had a friend who quit the analyst job because he had to write a report for what his boss wanted the narrative to be, find the numbers for it. And for Tesla, companies like Tesla, which is very few, maybe 1% of the stuff out there, they don't understand the business, and until they do, that's when the numbers came in, when it became profitable, then they can model it. I asked a friend who was a modeler. She couldn't model it when in 2012 because everything was negative. So I don't think and in the analyst switch, Adam Jonas says like $10 and now he switched boat, right? It's just like, so I don't need to follow those analysts, because you have to look smart enough, you can't look dumb enough. So if the whole market's going and then the stock is at $2,000 or pre-split, you have to have your analyst somewhere around that range, or else you look stupid. So you have to come up with the numbers to justify something within that range, even if you're bare about it. You can't be off like $5 when the stock is trading 200. So I don't think I don't think it's as straightforward as just understanding business and then you wait for the earnings. No, it's a sentimental part of it too. That's much more great.
I think you're mixing in so many different things, but you're completely wrong that that analysts can't model out this business. Like, I don't know what you're talking about. Have you ever read Piper Sandler's 100-page report deep dive on Tesla? Morgan Stanley, RBC, Goldman Sachs, they all published models around the Robotaxi business and Optimus. So what are you talking about? Like, this isn't some kind of like business that people can't conceive of, right? They're like, I can't possibly model this out. That doesn't make any sense.
Well, what's the
That's
numbers
not
then?
true.
What's the numbers that they have?
Go look
We
at.
don't know what it's
Do you
going
want
to
me
be
to
sold for.
send? Do you want me to send you all the reports that Sawyer has published over the past several weeks?
Sure. But if that's the case, they would be investing now. Like, why would you invest when the stock goes
They
up?
are analysts. They are equity research analysts. What are you talking about?
Yeah, that's my point. If you don't execute it, it doesn't mean anything.
So no,
It's
that's my
information out
point.
there.
My point is that you're saying you're mixing up so many different topics, and you refer to them as like a singular group of people. You're not even bifurcating between analysts and investors. And then you're saying that no one can model out this business. Like, what do you like? What? Like,
Well, Wall Street typically invest based on analyst reports, unless they go off a
again,
whim.
who is Wall Street to you? Have you ever worked in Wall Street? Like, do you have a finance background?
No, I studied
just
finance on
curious.
my own.
Okay, yeah, that makes sense. So yeah, there's look, like hedge funds don't go and open up an analyst report, look at their model, and then they're like, oh great, I'm going to buy it. They don't do that. I don't understand where you get this conception that
Then they
like
just buy it
these are
when
super
everyone else buys
naive
it.
people. No, that's what we spent the past hour talking about, and Simon walked through the decision-making process, right? Or the other considerations that different types of institutional buyers have to consider. But
Well, yeah.
that's the one main advantage that we have as retail investors. We're able to extrapolate further, not have other considerations for things like clients or your AUM or drawdowns that are happening because you're invested into controversial stocks or what have you. That's our edge. So I mean, it's essentially a form of arbitrage, but it's all related to the discount being applied to these future businesses. You think that autonomy will work out and Optimus will work out. You have no doubt. That's not the case for others. So it's really not that hard to figure out.
I think the Megapac's growth, innovation of rate and growth is much more significant, and it's not actually credited to the stock enough. I think that business is going to be dwarfing the vehicle side.
But you've never built a DCF model in your life. So how would you know that?
I look at the growth rate. If you do DCF, you have to do existing numbers. It's not based on the growth then.
You do projections. You project 5 to 10 years out. So what are you talking about?
Yeah, and everyone is saying you can't hit 500,000 by 2020, but they actually did.
Again, who's everyone? Anyways,
well, yeah, let me jump in because I want to ask.
I think the fact that most people on this forum understand the the future cash flow of this company 10 years out, in my view, it's still the greatest risk-adjusted opportunity that I can find in the market. And I think most people here would agree. And that's where lies opportunity. The models that I see with Microsoft, or we get access to OpenAI or NVIDIA, that opportunity is not there. But when the market and Wall Street are missing an opportunity, that's where you get the 10 and 20 baggers. And I think most people in this forum can agree with that.
So Simon, you said that you're a portfolio manager that's managing, I think you said 400,000 shares of Tesla. Are you, but you don't sound like you're a typical portfolio manager because you've actually tested FSD, you actually have the car, you do deep dives, right? Or do you think that other portfolio managers do this kind of detailed forecasting and studying and all that?
I don't think so. No, not other portfolio managers. I don't, even just to the extent that what we do, in terms of just doing your own work, doing your own research and looking under the hood. Most PMs, I think in the US as well, even in Canada, either rely on someone else to manage the money, or they rely on an analyst report. And when I go to conferences where you have the CEOs and CFOs of 10, 20 companies presenting their company, and you get all the major Wall Street or even Canadian Bay Street analysts in the room, you look around and you realize these are the people that are making calls on the stocks. And half of them are fresh out of university, trying to make a name for themselves and have zero experience of how the world actually works. And they're just running DCM models. They're not looking at what's the fundamentals of the business and what's the total TAM of that business, and all the fundamentals that people are looking at Tesla for. And other analysts that come out on the street, I read most of the reports, and then of course I go to TipRank and I see what they wrote, and I read the report, and I'm like, okay, how's the report? Why did they only come up with a price target of $100? And I read it and I go, oh, that's what they're missing. That's what they're missing. So to answer your question, no, I don't think most do. I decided, you know what, we're going to own this company. I'm going to try every car they have. I've got a Model 3 Performance on order, still waiting for it. And I don't need one. I just want to test their newest products and know exactly. It's my personal largest investment. And I've tried to get a tax write-off to say that, it's for research. I don't think our CRA, which is the equivalent of the IRS, is going to go for it. I'm kidding. I never filed that. But,
Simon, I think you're forgetting to mention one point that I think would be worth bringing up. But typically, when you think about the weighting of the fund, right? The allocations typically will be 1% to 2%, maybe 3% for a position. So you're really talking about a coverage space of something to the tune of like 50 companies that you're investing into at any one time, thus related to, the lack of ability to do complete deep dives and all that.
We're 30 companies. We have some staples on the outside. I look at it as three ways. We have a portfolio of like boring companies. Sometimes it's just for window dressing. And then we have our core holdings. I would say our top 10 makes up over 50, maybe 60% of our funds. Tesla's probably, its ranges. I'd like to keep it at 10%. Today it's maybe 6% because it's fallen significantly. But yeah, our top 10 is where we mostly keep our eye on, and it's not difficult. If you've owned Microsoft for 15 years and Apple for the same, like most of these companies we own for a very long time, Amazon the same thing, NVIDIA, AMD since 2015. Yeah, and then all we do in the portfolio is we add maybe one or two companies per year. If we find something great, it's very difficult to find a really great company. But all we do is we just shift the money around the portfolio, probably similar to what ARC does. But when we see every month we look and say, what are companies that we see a bit overvalued and what are the most undervalued companies? And we'll sell the ones that are over and add to the ones that are underweight. And we just continue. And that's how we were able to actually add alpha over time. I'd say we outperformed the benchmarks by 1 or 2% over time. And it's just from making sure you have an allocation according to where we see the value.
Let's do this. Simon, thanks for going through.
Jeff, you're covering your mic. Hard to hear you.
And so something, and I want to just Yoast is going to be going to the next slide. And then I want to go over the stock stuff. What to do with
Hey, Jeff, we cannot hear you. You're very muffled.
Oh, okay. Sorry. How about now?
Yes, thank you.
Okay. Good. We're going to go to Yoast and then stock.
Nope,
Now
do
you're
it, Jeff.
covering. And can we mute Simon while he's not speaking?
know.
Yeah.
I'm going to swallow the phone in a minute.
There you go. Now you sound better. Please talk.
Okay. Go ahead, Yoda.
Hey, Simon. I would love for you to maybe walk us through in your firm, just as an example, barring the ceiling of the 10% or certain caps like that, barring all those things, how do you literally get a decision to increase the position of a stock like Tesla in your firm? If you could walk us through the process of that and literally maybe the decision making role that is required. Obviously, don't use any real names, but just walk us through that process.
Sure. So it's not that complicated. We're not that complex. The firm that I work with, we're portfolio managers within the firm, so we run our own book of business. It's close to $1 billion that we're managing for private clients, maybe 200 households. All of our clients have technically the same portfolio, but then we do an asset allocation of, how much fixed income they need, what's their living situation, whatnot. So, we're not a large, money manager like Fidelity or PIMCO to that extent, or BlackRock. So when we make decisions, it really is the PM, which is myself and my younger brother. We've done a pretty good job in Canada. Our performance is one of the best across the country for a number of years. But it really comes down to us making decisions. So we look at it on a monthly basis and we say, what's the value and where do we think things are going short term in terms of how we're going to weight our holdings. We do look at technicals on the short term, though at the end of the day, it probably just tea reading. But we've been right on technicals, with Amazon and Google recently and stuff. But yeah, it's not that complicated. It's just where do we see value? We're looking at cash flows, we're looking at debt, we're looking at what's the opportunity, and we do have models where we what you say, what do we think this company is worth, and what's the bandwidth? So I'll give you an example of it. One of the greatest mistakes we ever made was we sold out of Costco about 6-7 years ago. We own it again now, and the reason for that was that the company, we had a model and we said this company is probably worth between 20 and 30 times earnings. It's just like TikTok. It's a fantastic company. And then eventually it traded to 36 times earnings. And we said, you know what? It's just overall, I don't see how much future growth you're going to get. This company only grows at, 10% per year. It's far too expensive. And we went to zero on it. And the lesson that we learned from that, because obviously the stock's more than doubled since then, was that if there's a really, really great business, even if it becomes what you believe is overvalued, don't go to zero. Bring it down to 1. Bring it down 1% in the portfolio, but you don't need to go to zero. If you got a great business, only sell out if the fundamentals of the business. So when we look at Tesla, for example, and we say this company's executing, if you take away the stock price and you go, what have they done in the last year? What have they done in the last 2 years? Are they executing? Are they losing market share, gaining market share? And as long as the company's executing and you can get past the stock price, then you shouldn't let Wall Street or the mainstream media ever sway your opinion of a company. I can't tell you how many times I've listened to the mainstream media say that Apple doesn't sell enough phones or people aren't renewing their iPhone enough. The iPhone's too expensive. Like every analyst wants to have their opinion, and it's a reason for people to get out of the company. But the company is more than 10x over the last 10 years. And you just have to forget it and say, what's the product? Is it excellent? And are they continuing to deliver? And are they doing them? I don't question what the pricing is of Steve Jobs or who's there now? I can't lose my thought. I don't question the management decisions. You just have to trust management that they know their business better than you, I, or the mainstream media or an analyst, and then just look at how are they executing.
Yeah, I think, Simon, you're definitely not the normal kind of PM, and you kind of remind me of Ron Barron.
Best compliment I heard in a long time.
And
Yes, for going through that, Simon. Appreciate it. Why don't we turn
Listen,
it? Sorry, do you have one more thing?
thanks, guys. Well, I'm here with my kids at swim lessons, but thanks for giving me the time to chat. You guys do great work, and I'll be on the next spaces.
Yeah, we'll look forward to come back. Thanks, Simon.
Good luck with that Model 3 performance.
Stock talk. Everything for the group. We're talking Tesla stock. We're talking moves and changes at OpenAI. Obviously, big move. You just posted about it. And just anything else going on in tech. But honestly, the conversation was around Tesla stock, near-term catalysts, risks, and just any thoughts you had on it.
Yeah, I mean, I'd say I probably, as compared to most of the Tesla community, probably think less about the short-term direction of the stock maybe than most people would like me to, or than most of the other people do. But look, for me, the story is still pretty much the same. I think, we've hit that inflection point that every reasonable shareholder should have expected the company to hit. Most companies, especially most megatech companies, start off with a niche product. They make that product reiteratively over a pretty long period of time. In the modern era, you've been usually at least a decade, and you saturate that market so effectively that it can fund all these other verticals and partnerships and collaborations to create the type of mega tech conglomerates that you see today. Your Amazons, your Googles, your Facebook, and so on. And so Tesla, it's funny because we had this argument all the time with the Tesla bears for many years. But this idea of Tesla being like, is it a car company or is it more than a car company? I mean, anyone with even a rudimentary analysis can see that it's not just a car company. The question is how quickly those other verticals catch up in significance to the core auto business. That's the real inflector of value. And Tesla's in that stage now, right? Where they go from being a company that was focused on a niche product set, attempting to saturate that market as effectively as possible. And I'm not implying that they've saturated the automobile market. The automobile market's pretty large, although not as large as people think, but still, it's still pretty large. And so, look, the core business can continue to grow and can continue to penetrate that market, especially as the EV adoption curve steepens, which it will. It's going to happen in phases. And on the topic of the EV adoption pace, that's another thing that I've seen a lot of nonsense about. Adoption curves don't happen at some standard pace every year in perpetuity. There are CapEx cycles that are huge drivers of acceleration when it comes to these things, especially with new technologies. And what happens sometimes is there's an intimate relationship between industry specific CapEx and the general cost of capital. Okay. And so when we talk a lot about interest rates from the perspective of the consumer, that's a very common thing to talk about. And, it's talked about pretty often in the Tesla community as well, because Elon has referenced it with relation to the auto business. But cost of capital doesn't just matter for the consumer. It matters all across the supply chain. And so what happens is if you have a technology trend that's coinciding with a period of very low capital costs, i.e. COVID, you have kind of a pull forward in the CapEx. And you have companies basically rushing out of the gate to dedicate as much as they can to something that might be rewarding from a future cash flow standpoint at that juncture, right? When we had near 0% interest rates and a huge flood of liquidity into not only public markets, but private markets as well, everyone was chasing the ball, including legacy auto companies, and they were willing to allocate $30-40 billion in 5-year projects to building new factories and doing all of these things. But then the music stopped when interest rates started going up. And it stopped very quickly because this is one of the fastest interest rate rise cycles in history, right? We rose rates very quickly from near 0% to 5+%, and that, I don't want to say put a chokehold on the economy, because the economy has actually been very resilient throughout all of this, and the consumer has been very resilient throughout most of this cycle as well. But what it did do was it throttled the enthusiasm that can only really be replicated in that type of environment, an environment where you have a robust, new, exciting technology theme, and at the same time you have a low cost of capital. But those environments are always fleeting. You can't perpetually exist in that space because, for any number of economic reasons, which I won't go into, but you can imagine all of the economic problems we would have for being in that state in perpetuity. And you can argue that the 20 years prior to COVID were an illustration of that, of an environment being too tech driven and too easy capital driven for too long. But again, that's a separate conversation. When it comes to Tesla, the throttling we've seen in the business in the past year is largely to do with the fact that the industry and most of the peripheral industries around it got ahead of themselves in the last 5 years. And any inflection down in demand, and that's really what we've seen. It's not that electric vehicles are going to or should have stopped growing and the trend is over. What it is that the pace of acceleration is slowed, and so all of that pulled forward capex has resulted in some supply guts, has resulted in, we've seen what's happened with the lithium markets. It's a great example. If you look at what's happened in the lithium spot markets in the past 2 years, you just had a lot of enthusiasm, and that environment doesn't exist anymore, where you have, this ease of capital combined with an exciting new technology. The technology is still exciting, but we've kind of moved past that part of the cycle. So you're going to have stocks that, especially stocks like this, where there's so much speculation and premium baked in, that are going to be extremely volatile during these periods. And that's really all that's been happening with Tesla for the past 2 years. It hasn't really changed my view on the long-term projection of the company at all. This is, to me, probably one of the only mega cap stocks in the world that is a binary bet. And it's a binary bet that I'm still willing to make, and I think a lot of people are willing to make, but it is a binary bet. When you look at businesses like Google or Amazon or Apple, the advantage that they've created is that they have such a dominant level of saturation in their existing core markets that they can float the business, try new things, fail at new things, and do that pretty fluidly without the stock suffering much, as we've seen the last 15 years. I mean, these stocks have pretty much done nothing but go up. There have been a few exceptions, but most of the mega tech stocks have done nothing but go up in the past 15, 20 years. And so, when you isolate Tesla, what makes Tesla unique in this equation is the story is still binary, in my view. And it's still a story that's dependent on software. And so, this isn't an initiative where Tesla can go fail at it and then come back and the stock's going to be in the same place. I think that's what makes Tesla, a unique stock here. And so, yeah, kind of ranting now and rambling, but you gave me kind of a general prompt there, so I hit on a bunch of stuff. But yeah, I mean, I'm happy to talk about whatever you guys want to chat about.
Well, what did Elon see in the last 30 days to drive this feverish activity? So obviously, it takes a while for these releases to get out to consumers. So he's talking about 12.4, but he probably saw the underpinnings and performance of 12.4 a month ago, or maybe even longer. What did he see, and what's driving all of this activity, and just the kind of the ramping up of full self-driving in his mind? What do you think he saw?
I think it's a little, look, where I'll start is I think the technology has dramatically improved since the end-to-end neural net, and I think that's pretty universally accepted now. I think that's consensus opinion for anyone that's tried it. But I think this is not just purely because he thinks the technology is ready. If I'm being frank, and I always, you know me, Jeff, when I'm talking about these things, I try not to be blindly bullish about things and provide both sides. But I don't think this is purely because he thinks the technology is ready. He may think the technology is ready. In fact, according to what he said, he thinks it's ready. It's ready for the big stage. I don't know that, because, that again would require federal regulatory approval, and it would, which may be by the way, and one thing I want to say about federal regulatory approval is that may be a smaller task than many of us assume. That may actually not even be that big of a hurdle in the road. So I want to be clear about that. But it is still required if we're going to deploy this federally as a hands-free, generally autonomous software. So that's point one. The second point I'll make is I do think to a degree it was out of necessity. Now, Elon's not dumb, and he understands, ago that he felt the stock was over. Said that in a long time, and I'm not implying that it is. But one thing that is objectively true, and I've traded stocks for a third of my life, like, the stock market is literally, I look at it every single day and I study hundreds and hundreds of companies. One thing that is objectively true is that stocks can ride on a narrative and they can ride on confidence and excitement and speculation for a very long time. Some stocks can run on that for a decade. But eventually, no matter what, there's an earnings call or a catalytic event or any number of things that could happen that make the rubber meet the road, and then the fundamentals matter. And look, the fundamentals too for Tesla in the last 5 years looked excellent. When the car business was growing 50% year over year, you projected that to a saturated market share in all of Tesla's key regions. You could see meaningful volume growth for quite a bit of time. And so it made sense to do forwardly speculate on the car business and say, look, the car business will become increasingly valuable, and to view all these additional verticals as just optionality to the upside. That was a really easy case to make 3 years ago. It has become harder to make that case for one reason alone, and that reason is because the volume growth industry-wide has slowed. And there's not much you can do about that as one player in the industry. When volume growth slows, I mean, Tesla was a beneficiary, while also doing an excellent job of being an industry leader, was a beneficiary of EV adoption ramping dramatically during that 3-year period. Now, when it slows, there is inherently less new volume available. It's just basic logic. You don't need to be a rocket scientist to make that deduction, right? And so now that the growth of the car business has stalled, and it has stalled, that is, again, just objectively true. It's not bearish for me to say that. It has stalled. And so because the volume growth in the car business has stalled, Elon knows the stock needs optionality. And so I think it's smart to make the pivot. It may not be, he may not have wanted to make it at this juncture, but I think it's the right decision. I think it's probably the only decision that can be made at this juncture because, again, for Tesla to become like the other great American megatech companies and basically be a stock that never goes down, they need a core business that can continue to show growth, and they also need a much better and more sustainable margin profile. Those are two requirements. Okay. And for Tesla to get a better and more sustainable and higher visibility margin profile, Tesla needs a substantially higher mix of their revenue to come from software. It's just objectively the only way to do it. Okay. It's very, very hard to do what Apple has done. And maybe Tesla can do it, but what Apple has done with hardware and the services ecosystem is like a nearly impossible feat. It's the brand that allowed them to do it, and just this amazing phenomenon of brand loyalty they had worldwide that lasted way longer, I think, than most people expected it to. People expected Apple's brand advantage to get eroded by competition for many, many years, but it just didn't happen. So, I'll put Apple in a separate category of having done this with hardware and services in a way that most other mega tech companies haven't. But when you look at the rest of the crowd, they're all selling software or some kind of peripheral software or some kind of software plus system that includes a suite of other products. The point is it's all software centric. And why? Because software has inherently better margins, and it's easier to sustain margins on software. It's also easier to raise prices on software with better features. So there's just an enormous amount of financial advantage to running a business that way. And that's what Tesla is doing now. That's the inflection point Tesla is at. I have no doubt in my mind about it. If you look at the events of the last 3 months, you look at all the people that have been fired, you look at the shifts in the business, you look at the shifts in priority in terms of CapEx priority. You look at the prioritization of compute. I mean, look at how much Tesla's ramped compute, right? Tesla's going to ramp compute 500% year over year. That's an enormous jump. That is indicative of intention. That isn't something that's just happening as a part of the business. If you're ramping compute 5x year over year, your intention is to eventually or gravitate towards being a software-driven business. And I think that's what Tesla's intention is. So, will it be successful this year? Yeah, I don't know. That's anyone's guess. I don't have a crystal ball. But is that what they're attempting to do? I would say without question, that is what they're attempting to do to the business. And it'll make it more asset light, more CapEx light, probably a better margin business overall. But the big feather in the cap that they need is they need FSD and or Optimus or both to make up a material portion of the revenue, arguably projected to be higher car business. And if that can happen, the stock will be fine. The stock will keep going up.
Yeah,
But if that doesn't happen, the stock will go down.
Yeah, I love those comments. I think it's spot on. And if you look at the direction of the company, like the you have to look at like where the revenue is coming in right now, which is, a high dominance on auto and then energy and then, on the services side. And then you have to look at it and how that gradient will change over time. The one thing I like about what they're doing with the auto business is they're really getting fit on the OpEx side. I mean, these OpEx numbers may be approaching $2 billion for all we know. I mean, it's an enormous number. I don't hear enough people talking about it, but they're really getting fit on the OpEx side. And that's inclusive of not only the the people that work in Tesla offices and sales and engineering and so forth, but it's also, there's been a lot of, factory personnel, which will hit the labor efficiency side of COGS. So how much it costs to make a vehicle. So I think there's been a tremendous amount of movement there. And I like the fact that every vehicle that Tesla is going to release over the next, call it 2 years, basically is a cheaper vehicle than it's replacing. So if you look at these interim vehicles before the new compact series are going to be, less expensive than the 3 and Y. And then after that series is the compact series, and there could be other variants that come off of that. But essentially, Tesla's getting fit on the kind of the OpEx side of the equation, and then they're taking the, in terms of the, at least in the auto business and quite frankly, the energy business, and they're taking tremendous costs out. The ability to extend this capital out that far, and then the ability for megapacks to start coming out of Shanghai, and you start looking at everything is kind of vectoring to lower cost product, higher featured or higher featured products, certainly more featured than its peers in terms of who they're competing against. And then you're going to have this whole FSD, software as a services, Robotaxi overlay. And that's, I think that's option play, number one, where it's going to be a super hard thing the time, as you say, like you're just not going to know, like, when is it going to hit, when's it going to be relevant. And then you have these other variables, like what if a licensing deal comes in, if FSD expands, in China and in rest of Asia, and then Europe, and you have all these plays coming up, and then you have risk too. You have risk on the unit side and the kind of the short term noise around that. You have risk in terms of kind of competition in China. I like the move of Tom Zhu going back there to kind of shore up that business. And I believe, by the way, if you've watched some of the videos, I believe the new interim vehicles will come out of Shanghai first. That is these things were put on the roadmap probably pretty recently. And the quickest point, if you're thinking about, if you're thinking about the network latency of the development process and you're thinking about the network latency of the production process, Shanghai is going to have anywhere else in Tesla beat in terms of speed. Their supply base is local, so they're going to be able to not only iterate in the pre-production, the development process more quickly, but they're also going to be able to ramp more quickly. So I think these interim vehicles are coming out of there. So Tom Zhu's focus back in China, I think, is key, both for FSD deployment and for getting these newer vehicles up. So I like where they're going on the vehicle side. Everything's getting trim, everything's getting fit. On the OpEx side, we're even doing cuts in China as well. So I like the direction, but these things are happening for a reason. It's not because there's near-term growth in auto TAM. I think total auto TAM, peaked like 4, 5, 6 years ago. It's more of what's the replacement rate going to be of EVs? What's that going to be by region? And does Tesla have the right capacity and the right place to execute and the right products at the right price point to execute on? So, a lot said there, I think, by both of us. Maybe we'll let Xander come up with a question and see if anybody else has a question. We'll probably try to shut it down around 7:30 Central. By the way, before we get to your question, follow the host, Cyberbulls, that account, and follow all the speakers and co-hosts on the panel. They've obviously invested their time and energy to have this conversation. They're doing research. Just follow them and also contribute to the conversation. Comment where you can. Thank you, Xander.
Thanks, Jeff. And I got a clarification question.
Xander, if you are talking, I can't hear you. Maybe others can hear you.
Can others hear me?
Yeah, we can hear him.
Okay, I'll go on mute. Go ahead.
Quick question. So, Stock Talk, you said material. Is that just like a broad term for it has to have some number, or is it material like a certain number you're looking for?
Well, there's two separate points to that. So the first being, if you're talking about material to analysts, that depends on the analyst. I think when I first came in here, there were some people on the panel debating about how analysts value stocks. The answer is there's no objective way. There's some analysts that are willing to speculate, and there's some that's not. There's some models on the street that have a forward model for Robotaxi. There's others that don't at all. There's some that have a very aggressive forward model for energy. There's some that have a very modest forward model for energy. So the answer to the first question of what's material to an analyst is it completely depends on the analyst. The answer as far as what's material for the stock, I mean, there's no number I can give you, right? I can't say like, oh, when it's 20% of revenue, the stock will start responding to it. By material, I mean that there has to be a path to project that software is going to dominate the revenue mix. Okay. And if that path seems far-fetched, like that's not going to happen at 3% software as aggregate revenue. And I don't even know what the number is today for what percentage FSD is of the total business, but I imagine it's small. But 3, 4, 5%, that might start encouraging some other analysts who are unwilling to model it to start modeling it, and the stock might respond to that. But this is like it's a hard question to answer, is really what I'm saying. I mean, there's no objective number to say like when software hits 20% of revenue, then everyone on the street is going to model the software business to dominate the revenue. Like I have no clue, right? So the point is it needs to be much more than it is today, much more. And I don't know what the impact of the free trial was. There was some speculation that the free trial was not very effective. I don't know whether that's true or not. Tesla's not disclosing exact take rate, so we'll have to see. We'll have to see what that revenue number looks like from a software standpoint, but I have no clue.
Awesome, thanks. And then since Jeff can't hear me, can you guys ask him?
Wonderful.
Did he say?
Xander, sorry if you're speaking. I can't hear you.
Did he?
Yeah, Xander was actually about to ask you a question. Xander, I'll relay for you so I can bridge the network. Okay, so go ahead, ask a question.
Real quick, did he say that the new vehicles are going to come from China versus Texas?
He's asking you if he said that the new vehicles are going to come from China versus Texas.
Yeah, I believe they'll be built everywhere, to be honest with you, but I believe they're going to start in China just due to the nature of them starting late, and there's kind of a tight timeline to get them into production. So the path of least resistance, shortest network latency for development time would be all those toolers, all those component makers are all in that vicinity of Shanghai. They're about 97% locally sourced around Shanghai, so and in China. So the path of least resistance would be to do it out of there. Cool. Thanks, Xander. Thanks, Adrian, for repeating that. I appreciate that. And for any of the speakers,
I am become human router.
Oh yeah, no, you're wonderful. I mean, you're so many other things you're wonderful for, but thanks for doing that, sir. And Anything else from the speakers on the panel? Any other final closing thoughts? Quick ones? Something we missed? Something we should have touched on? Something you should have touched on? Okay, if not, we'll close the space. Those 2.5 hours. Thanks everyone for joining. Again, follow the speakers. Thank you to all the listeners. Tell your friends about the space. I think if you find value in it, please join again in the future, and we'd love to hear from you. And drop any comments or suggestions for how we can run the space better. Thank you all. Have a good evening and great rest of your day. Thank you.
I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.